3 companies at or near 52-week lows. Guys, I talk about this a lot. It's a great place to look for value. When a stock has fallen a lot, you have to sit there and say, is this a short-term market emotional decision, or is it justifiable? And even if it's justifiable in terms of a drop, is it an over-exaggeration? You got to remember that stocks usually don't sell for what they're worth. They're selling for way higher than they're worth or way below what they're worth. Intrinsic value is a hard thing to come up with. But your goal should be to look at a company and say, this is clearly a buy. Those 3 companies we're going to evaluate right now. Stock number 1, Dollar General. The reason I decided to do this one, got a lot of news lately. You see, the stock price plummeted recently over one day, all-time high of $262 just back on April 21st of 2022, a little under 2.5 years ago. It is currently down to $83 per share. The low was last week, exactly a week ago, of $78 per share. So guys, Dollar General reported some bad news, etc. But if you believe a recession is coming, these stores tend to do pretty well. They really do a good job of catering to people who are trying to save money. Now, does that mean the company is an obvious buy? No. Remember, price is what you pay, value is what you get. This is an $18.4 billion market cap with an enterprise value of $42 billion. That's a lot of debt. Probably leases. That's important. But here's some interesting parts about the company. Selling for almost single-digit price to free cash flow. Selling for almost single-digit, and one of them is a single-digit PE ratio. You've got free cash flow in the last year greater than net income. But here's one thing I don't like. 5-year net income of $2.15 billion. 5-year free cash flow of $1.5 billion. Significantly lower. But that can be explained away if they had a one-time gain at some point that didn't appear in their free cash flow, etc. These are things to consider. Now, lower return on invested capital, still above our requirement for the 5 years at 10.8%, but this is going to be very attractive. 2.8% dividend yield, and it only eats up a third of their cash flow. So it's not like you're going to be worried about, is this dividend safe or not? Does that mean it's safe? I don't know. If the company's having some major issues that they're worried about, they could cut the dividend. But would you rather get a dividend at $83 a share or $270 a share? I mean, that's the big difference here. You've got a great dividend here if you like dividends, decent growth, decent gross margin, better than Walmart. So there's a lot of potential here. Let's see what the analysts are saying. Let's take a look at the 8 pillars here. So here's the story on the 8 pillars. Net income drop, cash flow drop, revenue is growing, a lot of debt, as we talked about. That could be okay for retail. That could be okay for retail. But a lot of check marks here. And guys, guess what? The stock is cheap at single-digit free cash flow. So the company feels like this free cash flow is going to grow from here. They better start buying back a lot of shares. That's a great way to get a lot of investor money back instead of the stupid dividend. Spend $500 million buying back 3% of the company every year. That's what I'd rather see them do when the free cash flow multiple is this low. But I'm willing to bet they're probably buying back shares at $260 a share. Who knows? Analysts, what are they saying? And the analysts seem pretty optimistic. Yeah, it drops this year, but then back to growth here to $12 a share in the next. So that'd be 7 times earnings for 2029. Revenue growth, yeah, mid-high single digits, 5-6% a year. So let's see what Stock Analyzer tool says. Let's see if I've done Dollar General in the past. I have last year. So I'm going to do 3, 5, and 7% revenue growth. I like the profit margin. Again, the free cash flow, I did 5.5, 6.25, 7% for profit margin. Free cash flow, I did about 1.5 points lower. PE. Now I went lower, probably because of the time frame. I'm going to sit here and put 13, 15, and 17. And then I'm going to do my 9% desired return across the board. Now remember, 9% is basically for intrinsic value. And there's a lot of positive stories about Dollar General. There's a lot of negative ones. The question you have to ask yourself is, which stories really matter? Okay. Now, I like looking at companies that are down 75%, especially ones that have good free cash flow, can still grow, etc. So let's hit the analyze button. Wow. Interesting. Look at this, guys. All green across the board. That's pretty impressive. 110 to 140, 150 to 200 in the middle, high side of 210 to 281 with great potential returns. Guys, if you know this company, it's all green, Never buy a company just because it's all green here. It tells you go do more. This is worth the research. If you're in our community, please talk about it in the community. Talk to Dalton. This is really impressive. I got to take a deeper look right now about this one. I'm going to do this right here let's go to their annual reports from our main page, 10K and March of 2024. We've achieved positive same-store sales growth each year since 1990, with the exception of 2021, which followed unusually high sale results in 2020. Okay. Net sales increased in 2023 to 2.2%. Sales in same-store sales increased 0.2%. So not a lot. But 1990 to now, they only missed for 1 year because it was probably because of COVID that's pretty impressive. So I like seeing that. Let's see how many stores they're closing. Okay. Here are the stores by year. Beginning of the year, they're closing about 97, 65, 105, opening. Okay, pretty solid. Decreased every year, but not by much. Net store change. That's 20,000 stores right here. 48 in U.S., located in 48 states and Mexico. Our first stores in Mexico opened in 2023. So they just started international expansion. Okay, could they grow this thing? This is pretty interesting to me. Very, very interesting. I think somebody's got to take a look at it. Stock number 2. A company that I own that I consider to be one of the riskiest plays I have, Intel. Guys, Intel's a doozy. Profits plummeted. They're scrambling here. I own the stock. Don't ever buy a company because somebody on the internet owns it. I'm here to teach a process on how to buy companies. This is one that is purely a turnaround play. All these numbers, pillars, don't mean anything right now. It's all about, can they get back to their original profit levels? Now, analysts are sitting here saying, look at this profit in 2028, $463. The stock's currently at $18 or $19. So if it makes $463, and at that point it gets back to its normal level of ROIC, let's say it's worth 18 times. This is a $85 stock. That's the question. Can it be an $85 stock in the next 4 years? If it can, that's a really good return. But it's kind of scary out there for Intel. I'm hoping they get back to their previous levels. Because look, the revenue, look at their revenue in the last, all these years. Look, we hit a peak here of $79 billion and it's fallen. Now, the good news is last year they did $54 billion. In the last 12 months, they did $55. But man, profit and cash flow are down significantly. They've made a profit every year, but significantly. They're making $21 billion a year. If they get back to that level, times 18, that's $360 billion market cap, and the company's currently 82. Again, 4 or 5 times its money. That's the question you have to ask yourself. It's purely a turnaround play. It's not for the faint of heart. If you choose to do it after your own research, don't put too much into it. I don't have a ton into it. I have enough where it went to 0. I'd be like, okay, that sucked. But if it went up, it would be pretty nice if it went up to this level. So to see how the turnaround play goes, I've been saying for a long time, it's a turnaround play. And it's going to be a multi-year play. It's not for the faint of heart. Question is, are the lows in? I don't know. I imagine if we have a big market sell-off in general, Intel's going to be hit hard. So we'll see. Stock number 3, I was very surprised recently when I did a video. Air BNB, still at very close to lower 52-week lows. 52-week low is 110. It's currently at 115, all-time high of 220 back in February of 2021, 3.5 years ago. Here's the interesting part. It's down 50% almost in the last 3.5 years. And its revenue is up from $6 billion to $10.5 in the last 12 months. And the stock is down 60%. Profit went from negative $350 million to a positive $4.8 billion in the last year. Free cash flow in the last year, $4.36 billion. Now, one thing I love is their 5-year free cash flow is 2.35 versus a net income of 443. These are the good numbers. $75 billion market cap. This company's a lot of great potential. Guys, we have properties on Airbnb. I love the process. Whenever I rent a house, I go to Airbnb and VRBO. So prime example, great company, great service. I didn't love the stock for a long time, but now it's a lot lower. Can make a lot of sense potentially. That's very interesting to me. I love looking at these 52-week lows for that reason. It at least piques my interest where I can sit there, quickly run through the stock analyzer tool and say, Paul, what should you add it to your watch list at? Now, let's see what analysts are saying about Airbnb. Analyst estimates. $460 per share this year, growing to $933. So basically 2x in the next 4 or 5 years, next 4 years, with revenue growing at 10 to 12% a year. All right, let's go to stock analyzer tool right away to sit there and see, because guys, I did it back in August. I did 10-year analysis here, and I did 4, 7, and 10% revenue growth. Their 1-year ROIC is 21%, high ROIC. This means this company gets a good return on the money. Guys, Airbnb has changed the way in which people rent and ways for people to make money. I just bought a house in Texas on a lake. I'm putting it, for myself personally, I'm putting it on Airbnb. Why? Because if I rent it out 10 days out of the month, I'm going to be able to cover my entire cost for the month. So why wouldn't I? Because my wife and I are not going to use it 20 days out of the month. We're probably going to use it a total of 40 or 50 days a year. So if it's sitting there, I might as well rent it out and cover my costs. That's extra money I could be doing something else with, taking other trips with my family. That's what's so great about Airbnb. It has totally changed the way in which people can make money on their properties that exist. When I go to another city, if I go to a city, I want to stay in Airbnb. I love doing that. Now, has there been some security issues? Yeah, but you just got to pay a premium for higher quality, more experienced Airbnb rentals. That's it. I love the idea now that every city I love in the world, I could essentially buy a property and cover the costs of that property and make some money off of that property. What a great luxury. And you don't have to stay at a hotel if you don't want to. Now, with that said, there are obviously risks with that, but I really love this business model. It's such a great business. Now it's just a matter of finding the right price for it. So, profit margin. They did 46% last year, free cash flow 41%. I basically I looked at free cash flow saying 20, 33, and 45. This is going to be a wide range of values because these are big differences in profit margin because the business is so young. We don't know where it's going. It's too young to say this is exact profit margin. There's been a lot of regulation. Listen, I wanted to buy a house in Georgia. They've banned short-term rentals in many of the counties. And even the county that allows it, Putnam County, are only limited to 350 houses and they have to be certain zoned areas. So with great service comes more government regulation. You've got to be ready for that. So before you make an Airbnb investment, whether it's a property or the stock, make sure, like look at Uber, the same thing happened with Uber. Make sure you understand those risks going forward. Because it's just a matter of people saying, no more Airbnb, no more short-term rentals allowed. Now, granted, do I think it's constitutional? I'm sure there'll be some sort of fight on that one in the future. Now, guys, these are the conversations you need to be having with investors and other people that you know. Now, if you're like me, you didn't know many value investors. You were alone in this lonely world. That's exactly why this community was created. And if you may have noticed that if you go to everythingmoney.com, we only have a limited number of daily spots for our community and software. And the reason for that is that the software as it exists today currently includes everything that you have to do with retirement, stocks, and real estate. All these tools. But now we're growing. We have 4 YouTube channels. We're going to add 2 or 3 more. And we're making big changes as we continue to expand. So these offers are going to go away very soon where you have to buy them individually versus everything. So the current offer of everything is going away. But if you remember, if you've been watching us for a while, I made this software for myself that my team and I could constantly make better decisions. I bought my real estate deals that I just talked about using Real Estate Calculator. I just bought a $22 million apartment building using Real Estate Calculator. That's what I do to make better decisions. So as the channel grows, as the community grows, it's becoming less about me and more about how I can serve you and the community members. But the good news is these changes haven't happened yet. So if you sign up today, at the link below in the description, you're going to get all these tools for life. You'll be locked into your pricing tier forever. And you get all the data and all the tools to be able to enjoy them and make better decisions. You're going to get all of it. This is the best deal we're ever going to offer. So if you're really serious about making better financial decisions, probably increasing your returns, and more importantly, sleeping better at night, click on the link below. Go do it before you make the changes. And by the way, guys, it's $7 for 7 days. That's the current trial membership. We're not asking you to make some long-term commitment. $7 for 7 days. So guys, we're looking here. I did 14, 16, 18 PE. Now, guys, they have a high return on invested capital. And when you have a high return on invested capital, along with some sort of moat feeling, you can justify a higher PE and price to free cash flow. Now, if I went around and asked 100 people, if you want to rent a house or something like that, where would you go? The vast majority are going to say Airbnb or VRBO. Now, I'm not saying that means they're a moat, but they were the first. They did a great job getting a market. They did a great job with brand awareness. And they lost money for years, making sure people knew they're the ones. And it's translated into really, really high margins right here. So do I think this company can justify higher PE than this? Sure. I think I'm going to put I think what I'm going to do here is I'm going to do 13, 16, and 19. So I'm really driving down this value on the low end, but I'm giving the upside potential if they're able to do these growth levels. I don't think 10% revenue growth per year for the next 10 years is unreasonable. I don't think that's unreasonable. But I got to put it all together and see it together and see is it an obvious buy. And of course, I did my 9% desired return to match the market. But of course, you need to put margin of safety in here by having a higher desired return. So hit the analyze button. Boom. Low price of 50, high price of 220, and it's basically at its middle price. I have it in my watch list at 85, mostly because I want to see how things pan out, but maybe I'll change it to 100 to start doing more research. Thank you very much for your time.